My name is Chris Holmes and I'm a member of BDO's Tax Support for Professionals team. Welcome to our webinar on statutory demergers, being one of 3 webinars on tax efficient demergers. BDO TSP provides first-class tax advice to accountants and other professional advisors from a long-established market-leading team. For more information on that service, including joining the mailing list for our free easings, please visit www.bdo.co.uk/TSP or call us at the numbers provided at the end of this presentation. In practice, the reasons given by callers to our helpline for considering a demerger range greatly. Often shareholders are in dispute and want to split their interests and go their separate ways. Also common is a desire to prepare companies for future sale, either by removing investment properties to protect the entrepreneur's relief or by separating trades and assets into more saleable parts. Removing former trade premises into a separate company for development is also a common theme, as is division of assets following divorce. Occasionally, we may also receive requests concerning companies founded by siblings now passed to the second generation. Although the children may be happy to share with siblings, they can be less keen to share with cousins. The basic objective of all methods of demerger is to minimise the tax cost of doing so. The main tax costs to be considered include taxation of distributions for shareholders as either income or capital gains, chargeable disposals by shareholders or companies, degrouping charges, stamp duty, SCLT charges, and VAT. Statutory demergers are only available when separating 2 distinct trades or trading companies. If you are looking to demerge anything other than 2 trades, then the statutory route is not available and you'll need to consider the alternatives. Amongst our TSP clients, we will often find that where a statutory demerger is available, it is the preferred method due to its simplicity and relatively low cost. But even with separating trades, it is not always the best option in all circumstances, so alternatives should be considered. Statutory demergers are in essence a dividend in specie of the underlying trade or shares. They are in law an income distribution, but specific tax legislation deems them to be tax neutral for the shareholder, providing conditions are met. There are 2 forms of statutory demergers exempted by different parts of the Corporation Taxes Act. I'll explain these further on the next slides. But I will note here 2 of the major differences between the methods that will often influence the choice made between them. Firstly, a direct statutory demerger can only be used for distributing a 75% trading subsidiary. In contrast, an indirect statutory demerger can also be used for demerging a standalone trade carried out by the demerging company. Secondly, there is no specific relief for the distributing company in respect of corporation tax on its disposal of its shares or trade assets, but a direct demerger of shares in a subsidiary may be within the substantial shareholdings exemption if they have been held for 12 months, such that the gain is exempt. In contrast, an indirect demerger relies on a relief under Section 139 TCGA as they constitute a scheme of reconstruction under which the transfer is for nil gain, nil loss. Here we have a very simple direct demerger of a holding company with 2 trading subsidiaries. Holdco distributes its shares in Tradeco 2 directly to the shareholders. Section 1076 CTA 2010 deems the distribution to be tax neutral for the shareholders. Holdco is making a disposal of the shares for corporation tax on capital gains purposes, but substantial shareholding exemption may be available if the shares have been held for at least 12 months. For indirect statutory demergers, rather than distributing directly to the shareholders, the shares of Tradeco 2 are transferred to a new company that itself issues shares to the shareholder. Newco will then act as a holding company for Tradeco 2. Section 1077 CTA 2010 deems the distribution to be tax neutral for the shareholders. As it constitutes a scheme of reconstruction, the disposal by Holdco of its shares in Tradeco 2 to Newco is a nil gain, nil loss transaction. Next, we have 2 examples of statutory demergers that involve trades being demerged into separate ownership. Mr. A and Mrs. B together own a company with 2 trades. The objective is for Trade A to become wholly owned by Mr. A and Trade B to be wholly owned by Mrs. B. This can be achieved by either a direct or an indirect statutory demerger. First, we look at the direct statutory demerger route. Firstly, it is necessary to reclassify the ordinary shares held by the shareholders so that Mr. A holds A shares with rights restricted to the income and assets of Trade A. Mrs. B will hold B shares with rights only over the income and assets of Trade B. Next, Holdco forms a new subsidiary into which it transfers the assets of Trade A. Holdco then distributes its shares in Newco directly to Mr. A. Mr. A now wholly owns Trade A within the new company. However, he also still holds his A shares in Holdco. These A shares are now worthless as the assets over which they have rights are no longer owned by Allco. The A shares are therefore cancelled or more commonly sold to Mrs B for £1. Mrs B is then sole owner of Allco and Trade B. Next, we will look at how the same objective can be achieved through an indirect statutory demerger, as shown on the right of the slide. Again, the shares will be reclassified into A and B shares, with rights restricted respectively to the two trades. Mr A then forms a new company. Allco transfers A to Newco, in consideration for which Newco issues additional shares to Mr A, making this a scheme of reconstruction. Again, Mr A is left holding worthless A shares in Allco that will be cancelled. The end result is again Mr A owning Trade A through the new company and Mrs B owning Trade B through the Allco. Of these two examples, the indirect statutory demerger may be preferred as substantial shareholding exemption will not apply in the direct demerger as Newco would not have been held for fully required 12 months. And there may also be degrouping charges on the distribution of Newco in respect of assets previously hived down in the direct demerger. In contrast, the transfer of assets to Newco during the indirect demerger is usually tax neutral as a scheme of reconstruction, although the specific legislation for each class of assets would need to be considered and some elections made for stock or capital allowances. As explained previously, the demerger must be of two trades, so it cannot be used to demerge investment assets. It should also be noted that the test for the purpose of benefiting the trade is a higher hurdle to pass than the bona fide commercial test for other methods of demergers. It is still not a difficult test to pass, but does require a more considered justification for the clearance. The other points are that although all companies must be within the EU, it must be the whole or substantially the whole of the trade transferred, not simply a trade asset or part of a trade, and it must not be for tax avoidance or one of a short list of disqualifying transactions. The important points to watch are that the relief can be clawed back if a chargeable payment is received from the demerged company within 5 years. The shareholders need to understand the circumstances under which a clawback might arise, as it may affect their future plans for the demerged company. Because the transaction is fundamentally a distribution, the company must have sufficient reserves for it to be lawfully made under the Companies Act. And as previously stated, distribution of an asset is a chargeable disposal by the distributing company, although reliefs may apply. In respect of stamp duty and SDLT, a direct statutory demerger will not be liable as no consideration is paid for the shares or properly distributed. However, for an indirect demerger, the new company is issuing shares to the shareholders as consideration for its acquisition of the trade property or the trading company. Stamp duty and SDLT reliefs are available, but only if the shareholders before and after the demerger exactly mirror each other. Stamp duty and SDLT will therefore generally be due for an indirect demerger where ownership of trades has been separated. Finally, where a prior transaction has been undertaken within the group, either in preparation of the demerger or previously, it will be necessary to consider whether any degrouping charges may arise as a result of the demerger. Remember that each set of degrouping provisions differ from the others, and so each requires careful consideration. For example, SSE prevents a capital gains degrouping charge, but does not stop a corporate intangibles degrouping charge. These points are relevant for all methods of demerger. Valuations need to be addressed at the start of the process as they are fundamental to the choice and structure of the demerger. Without knowing the valuations, you cannot assess and compare the levels of taxes at stake. I would estimate that in roughly half the demergers in which I have been involved, an issue with the share register was discovered shortly before the implementation. These have ranged from ex-employee shares not being properly cancelled to bonus shares not having been issued to all the shareholders entitled to them. Correcting the share register adds additional and unexpected costs to the implementation and did in one case completely derail the demerger. Often we are asked to include changing the share ownership during the demerger process. This is always best dealt with as a separate exercise, either immediately before or after the demerger. It is an unnecessary complicated transaction that would lead to additional costs and more often than not additional taxes. So a simple transfer by sale or gift before or after the demerger is by far the better option. BDO will always recommend that statutory clearances be sought when they are available. A single clearance will cover the entire demerger together with any related transactions. It should be noted that if there is an imminent sale on the table, HMRC are unlikely to give clearance and the risk of HMRC seeing a tax motive are increased. So demergers of all kinds are always best carried out well in advance of any anticipated sale. The clearance we recommend are the specific clearance under statutory demergers within section 1091 CTA 2010 in respect of the shareholders tax, If it's an indirect demerger, clearance should also be requested that the transaction is a scheme of reconstruction. For the shareholder, this will be under Section 138 TCGA for the application of Section 136 of the same Act. And for the demerging company, clearance should be sought under 139. Section 701 transactions and securities clearance should also be sought. That concludes our webinar on statutory demergers. If you would like further information on our tax support professional services, please call these numbers or visit the website. You may also be interested in our LinkedIn group, which is a place for tax practitioners to discuss issues affecting their firms and their clients. If you would like an invite, please send me an email.